One. And welcome everybody to another Smart Money Circle update. I'm Adam Sarhan. With me today is Jonathan DeYoe, who's a CPWA, which is a certified wealth advisor, senior vice president, EP Wealth Advisors at their office in Berkeley, California, with firm-wide about $15.1 billion in assets under management. And he's the founder of Mindful Money. Jonathan, welcome to the show.
Adam, I'm excited to be here. Let's have a good combo.
Likewise. So, Jonathan, I always like to ask, can you please tell us your story and how you got to where you are today?
That's a long story. So we must have at least 2 hours, I hope.
We've got time.
Okay, we've got time. Sort of to track back my interest in finance, it comes from growing up with very little money. And I'll just go quickly over that. Like I traded my first stock when I was 9 years old.
Nice.
So, I took my lawn mowing money, my candy sales and bubblegum sales money, and some gifts from grandma, and I bought a First Bank System. My goal was to, make some money and buy a bicycle with it because my parents couldn't afford some of those things that I really wanted. Mm-hmm. Unfortunately, this was the 80s, just before the savings and loan collapse. And so I lost half of my investment. So I learned a good lesson right out of the gate. But I really fell in love with investing. I went to my undergrad. This is 10 years after that purchase of the stock. And I went to my undergrad to study finance. Totally bored me to tears. So shifted to philosophy and religious studies and spent about 7 years studying comparative religion, getting more and more focused on sort of the Buddhist academic world, really understanding how the mind works. And halfway through my master's program, or say 3/4 of the way through the master's program in Buddhist studies, my first wife said, "Hey, it's my turn to go to school." And I dropped out of the Buddhist program. And so at that point, I've got a degree in philosophy. I've got a unfinished master's in Buddhist academia. What job do you find for that? So,
now what? Yeah.
I went to what I knew, which was investing, and I just sort of interviewed a couple of places, and Dean Witter hired me, and I spent, I think, 5 years at 7 different firms. I bounced around. There were mergers and acquisitions, all that kind of stuff. 2001, I started my own company. 2021, I actually merged that company into EP Wealth. 2017, I published my book. Second book is working on the second book right now. So there's, that sort of brings us up to today.
Excellent. I love that. Can you tell us a little about your book? I know it's a best-selling book. The title is Mindful Money, Simple Practices for Reaching Your Financial Goals and Increasing Your Happiness Dividend. I absolutely love that.
Absolutely. Yes. So the book is pretty simple. It's broken down into 3 different parts. And the thing that sets this book apart is it's a finance book. And so when I was writing it, I was wondering, and all the consultants were saying, which part of the bookstore is this supposed to be in? Is it supposed to be in finance? Is it supposed to be in self-help? Is it supposed to be in religion? Where does this book go? And it kind of fits in all 3 categories, but it ends up in the finance category, personal finance category. And the reason it ends up there is because the 3rd section of the book, you can write your own financial plan with each of the exercises in the back of the book. There's a nice workbook in the back. You can do that. But the important part and the difference from the book is the first 2 sections. So the first section of the book, it's all about going over the illusions, the things that people think they can control, or the things that we're told matter in the decision process of investing and saving and all this stuff that we can't control, that we should just ignore. So there's 8 illusions, could have been 7, could have been 12. I brought it down to 8 illusions. It's kind of a good Buddhist number. Middle part of the book. So if you can ignore those illusions, those things that we think we need to pay attention to, and we got to know what to focus on then. So the middle part of the book, we establish, after 2,500 years of history of people, philosophers, religious people, psychologists, academics in the modern era, asking the question, what makes human life worth living? We figured out there's probably, 6, 8, 10 things. 10 things that lead to well-being. I focus on 8 of them. 2 of them became 1. Again, I'm not trying to make the definitive it's 8. It could be more or less, whatever you choose. But we talk about the 8 things that we think, things like gratitude and optimism and accountability and things like, like your health, your relationships with other people, things we know. Like these are things we know. We've been told for generations that these bring about happiness, bring about well-being. So you strike all the stuff you don't need to think about. You bring to the focus the things that are really, really important to well-being, not just financial success, but well-being. And then you build upon that. And that's the structure of the book. And I think that's why the book is so well received, is we don't just go, hey, you got to plan, you got to invest, you got to save money. That's not it. There's a bunch of stuff that leads up to that enables the process of planning.
No, I love that. So I'm very big on psychology and mindfulness as well. My book was #1 on Amazon, as you know, Psychological Analysis. So I'm going to dive a little deeper, if that's okay with you, because I'm really interested. What are those illusions that you speak about? I speak about cognitive biases and things that mess with the brain. I call them mental walls. You do something, you hit a wall, people stop, but successful people break through those walls and keep going. So first, that question is, what are some of those illusions? And then the second question is, what are those in the middle? What are those 8 principles that you speak about?
Yeah. So we don't have time to go over every illusion. So there's 2 that sort of stand out, and 2 that I talk about a lot. The first is there's a confusion about what is currency and what is money. Lots of people think that currency and money are the same thing. The problem with that theory is it discounts inflation. So currency, if I have a $20 bill and I have that same $20 bill, 20 years from now, it'll buy, what is that? It'll buy, what is it? $8 worth of goods. Roughly $8 worth of goods, right?
Less, yeah.
Much less. It's the basket of goods that shrinks. The currency stays the same, but the basket of goods you have access to with that currency declines. The definition of money is the basket of goods. So you need a certain amount of money to purchase a basket of goods. And so if your currency value is in constant decline, then you shouldn't be protecting your currency. You should be protecting your money, which means when we invest, the thing we look at as risky, equities or equity in real estate or equity, the thing that we call risk is actually the thing that we need the most of to outperform that inflation problem. Okay. But if all we think of is our currency, if what we're trying to protect is our currency, then we lose out to inflation every single time. So that's the first really, really, really important illusion. The second really important illusion, and there's 8 of them in here, but the second one I talk about the most is this idea that risk and volatility are the same thing. What I've always said, and this isn't my invention, I think I heard it first from Nick Murray 25 years ago, right? Risk is the risk of human error, right? So the idea is markets are volatile. That's what they do. It's a price function mechanism. It goes up, it goes down. It's trying to figure out what the right price is. Behind the scenes, businesses are always working to increase revenue and earnings and dividends. And the track record historically is incredibly consistent that they do this. This is a reliable thing. But we confuse the short-term volatility with risk, and that makes us shy away from investing in things that are called risky. So one of the biggest problems in personal finance, the biggest problem is probably we don't save enough. I think the second biggest problem is we don't invest enough of those savings in equities or in equity real estate or equity, right? So everyone wants to buy a bond, everyone wants to have cash. We don't own enough equities. So both of those illusions lead us against investing in equities. And so really understanding those 2 illusions helps us get over the hump of what I think is the second biggest problem facing the financial services world.
I love that. Those are really, really good illusions and lessons as well. How about some of those principles in the middle of the book?
Yeah, the one that throws people the most, everyone knows the 2 things. If you ask someone that's 70 years old what they wish they would have spent more time on, they will tell you. And just test this. Go to someone that's 75 and ask them this question. What do you wish you would have spent more time on? Every single one of them says health or relationships or some version of those 2 things. So those 2 things, let's just set those to the side. That's a given. Health, relationships, critical. And just a little personal story. I during the pandemic, I let my personal circle of friends tighten to basically one person. And I don't know if you know this about my story, but the person was my brother. And in June of 2021, my brother died. Ooh, so I'm in the process of developing friendships or rekindling friendships. It's a skill that I haven't practiced for years and years and years and years. My anticipation was my brother and my brother's family would be around for a long time. He died in June. And so figuring that out, it's hard to start over with friends. So You've got friends, man, hold them close, take care of them, have coffee with them, fly across the country to see them if you have to. You have to maintain those relationships. They become very important when people really, really close to you die, and they do. That's the lesson is it happens. As the bumper sticker says, it happens, and you got to work around it. So that relationship one is pretty important. Health is pretty important. The one that I talk about that people I think gets the most questions is this concept of accountability. It's interesting once you become introspective and you think about what's important to you and what you want to pursue, sort of as life goals, as personal goals, relational goals. Once you identify those things, if you don't do anything about it, these are the things I love and want to pursue, but then you watch TV, you have a hard time not judging yourself, not saying, oh, I'm pathetic. Oh, this is so sad. I mean, once you identify those things, you've got to hold yourself accountable. You've got to take steps. You've got to take the action. Because if you don't take the action, you start, resenting yourself. You start hating yourself. And this is deep, deep, deep stuff, right? So, and I counsel people should be introspective. People should figure out what's important to them. Once you do that, you got to hold yourself accountable. And if you need an accountability partner, whether that's a brother or a friend or something like that, it's a great way to do it. Figure out what you want, hold yourself accountable to those ends.
Yeah, I love that. It's really, really good advice. I'm sorry for your loss with your brother. That's not fun.
Yeah.
Okay, so when we talk about money and currency, I love the difference there because inflation grows. The basket of goods you buy is going to grow with inflation, but your $20 is still a $20 bill. 50 years from now, 100 years from now, it's not going to change, but inflation is going to continue to grow and the basket of goods continues to dwindle. So let's talk about, and you talk about risk and volatility. You brought some really good points, and then the points of health and relationships. Nobody at 70 says, I wish I would have worked more hours or something like that. You're absolutely right. Let's talk about your investment strategy. Please share that with us.
Yeah, I'm sort of old school, asset allocation. Don't overthink it. Keep it as inexpensive as possible. Buy your indices. Diversify as broadly as you can. For me, it starts with, you understand what's important to you. You build a financial plan based on what's important to you. Your financial plan will basically tell you how much risk exposure you need, how much exposure you need to those things that go up in value at multiples of inflation. And that's equities, it's equity real estate. That's, in a nutshell, that's pretty much it. Nothing else does it. And so then it's a matter of, let's say 80% equities is the right portfolio for you. If that's the case, then that 80% needs to be broadly allocated globally. You need to have big companies and small companies, tech companies and energy companies. Once you own, my personal portfolio has 15,000 companies. I happen to use the DFA model. So I love value, small cap, and profitability. Those are the things that we know historically provide a greater return over time. They don't work every time, but they work over time. And that's the longer you stick to that philosophy, the higher the probability you have, great long-term performance. No one knows what's going on in the future. So my portfolio design is the simple, most academically defensible portfolio you can possibly think of. I don't try to guess what stock's going to do better next. I don't try to guess which industry is going to do better next. What I do is I rebalance. It's simple. Like this piece of the portfolio is up. Let's sell a piece of that. That piece of the portfolio is down. Let's buy some more of that.
Understood. That's very interesting. So you invest in individual stocks, ETFs, mutual funds, however you can get exposure to that broad diversification.
Yeah. The tool hardly matters, right? It's the broad diversification, asset allocation, rebalancing that matters.
Gotcha. So how do you handle, let's talk about risk, since you mentioned risk. How do you handle risk, and what mistakes do you see people make with respect to risk management, and what advice would you give going forward?
It's not that we ignore risk. So I want to say it's not an ignoring of risk, but it is really important to understand that volatility and risk are different. And the risk in investing in a single stock or a basket of 5 stocks is that 1 or 2 of those will go under. And if you saw people in the late 90s or actually leading up until the end of 2021 who were very enamored of, say, large cap growth.
Right.
People that get enamored of anything ultimately lose. They have a period of time where they outperform everybody for 8 years, which is what happened leading into 2021. And then they're handed a year that takes all that outperformance plus some away. So the idea of broad diversification is volatility happens. It's not risk. The problem comes is if you second guess the plan. So if you have 15,000 companies in ETFs and mutual funds and your emerging markets is cratering, it's going down, and that makes you nervous, and you sell it, that's a human error, right? That's a human problem. That's not a market problem. So understanding that volatility is natural, and understanding that risk is of human error just leads you back to, well, okay, we should just keep it asset allocated, diversified, and rebalance it as necessary. And so how do we manage risk? We're just not as concerned about risk. We're not as concerned about the thing everyone else is calling risk. So what is risk? Risk is actually that I will get to the end of my life without enough money. That's the real risk. It's not that markets are going to zig and zag and take the money away. It's that I won't save enough and my investments won't produce enough.
Right.
So how do I make myself save enough? Well, I plan. Then that plan determines me conservative outcomes, what I should be saving. And it also tells me how I should be investing, how much risk, how much volatility I should suffer, how much, that I have to stick through. Then if you just do it, it works. You can't do it in a 3-year period. It does require 20, 30 years to work, but it does work.
Yeah, no, that's very powerful. So what are some timeless lessons, Jonathan, that you've learned along the way that you'd like to share with the audience?
I keep fighting against this one. 2, actually. Well, there's one that I fight against and one that I embrace entirely. So even when I entered the industry in the beginning, and today, for the last 25 years, everyone talks about, everyone needs to have a bond portfolio. Everyone needs to have bonds. Everyone needs to have fixed income. Everyone needs to have it. It's got to be part of the portfolio. And I struggle with this because the math doesn't support that. The psychology supports it. So I understand the reason to have it as a ballast. That I totally get. I totally agree. Some people can't stomach the volatility. But if I know that the long-term after inflation return of equities is 7, and the long-term after inflation return of bonds is 2, why would I own the 2 instead of the 7? Like, I don't understand that. And by the way, the income that spins off of the 2 is static, and the income that spins off of the 7 is increasing over time. Like, it doesn't make sense for me to own a lot of the 2 when I can own the 7. The cost of that is I got to deal with the volatility. I got to manage that volatility. Does that make sense?
Yeah, no, that makes perfect sense. So what are some timeless mistakes that you'd like to share that you haven't already shared? Because you gave us some really good. Don't confuse risk with volatility. Make sure you understand the difference between currency and money. Make sure you understand why you're investing. Focus on those health and relationships, and make sure you put money in its priority, health, relationships first, and then money after that. What are some timeless mistakes that you haven't shared so far, that if there are some, that you'd like to share with the audience?
Well, there's the two we just added to that, and then that's the save more. I mean, the first problem that we have as a country is we don't save enough. And whether that's whether you are an employee of a company that has a pension or a nurse at a hospital that has a pension, the pension doesn't save enough either. Mm-hmm. Like, no one is saving enough to meet the goals that people have. And so save more. And then the second one is greater exposure to equities and just being okay with it. So how are we okay with it? And this is the one that's a little bit more, far afield. Meditate every day, 10 minutes a day. And what happens, and I'm actually becoming a meditation teacher because there's so much power in this. I've done this for 26 years. I just got back from my 7-day silent retreat. Understanding how your brain works allows you to think about economics for the last 50 years, right? 50 years ago, economics was traditional economics, right? It was the rational man theory. And it was, we all would behave correctly if we had the right information and right? 25 years ago, Kahneman, Tversky said, not quite the case, all these biases, we have all this, stuff that goes on emotionally and cognitively that tells us we don't actually see the world as it is. We don't actually make decisions with full information. We just make tons of psychological things. And then they say, good luck. They give you no tool to deal with the fact that your brain creates a veil over reality. Okay. There is a tool, and that tool has been there for thousands of years. And it's meditation. And they've done the research on this. Academics have done research on this. And what they've said is people that commit to 10 minutes a day of just introspection, meditation, call it what you will. They increase the size of their frontal cortex. They decrease the size of their amygdala. That's huge. The thing that causes us to make mistakes is we react, and then we forget that we have proactive decisions we've made because we are reacting to something going on in markets.
Right.
But if we've made a plan and the plan tells us what we should do, and we can just take a moment, we pause before we react and we look at the plan will say, no, markets do this. What you do is rebalance. That's what you do. You don't pull away. You don't go to cash. You rebalance now. That's what you do. And if your plan says that and you have a moment and you can catch yourself before you react, it's like your plan becomes your breath when you're meditating. You return to the plan. What should I do? Return to the plan. What should I do? Ask the plan. Can I go do this? Ask the plan, right? The plan becomes the answer to all the questions you have about your financial life. And if you can use it that way and remember that it's there, that's mindfulness. That's being mindful of the plan.
Yeah, I love that. So I do my work on the weekends when the markets are closed and plan the week ahead coming up, and then I adjust that way. Okay, so I can go in a million directions here, but let's focus on meditation, because I think the overlap, it's like the Venn diagram of meditation and trading or investing, is just so important, but so overlooked. Let's start from the very, very beginning. What is meditation and how do you meditate for those that are not familiar?
So you would almost have to live under a rock to not have been exposed somewhat to meditation. But meditation in the simplest format. First of all, let's define what mindfulness is. Mindfulness is the non-judgmental awareness of the present moment as we experience it through our senses, through our thoughts, and through our feelings. Okay. So a couple important pieces there. The most important thing is non-judgmental. Mm-hmm. So the idea when you're meditating is that you're going to have something you're focusing on. This is a beginner's meditation. You have a focal point. Could be your breath, could be a candle flame, could be a photo on a wall, whatever, a spot on a wall. What you're focusing on something, and you focus on that thing, and you breathe. You breathe in, you breathe out. You focus on your breath. You feel the breath go into your nose. You feel your lungs expand. You feel your stomach expand. Then you breathe out. The reverse happens, right? And then a couple seconds in, you'll notice that your mind has wandered. That is the special point in meditation, because once your mind has wandered, the first time it wanders, you won't notice. It's just going to wander, and it's going to create a story, and that story is going to cascade, and it's going to grow, and it's become a 3 to 5 minute story. And then 3 to 5 minutes later, you're going to realize you've planned your day, you've had your lunch, dinner is all planned out, and you're still trying to meditate. And you go, oh, I'm supposed to be meditating, and that's when you bring your focus back. That's all meditation is. It's a constant bringing of focus back to, your breath, soft shoulders, soft mouth, soft jaw, something like that. You're going to bring your attention back. And that's a practice. And it's a practice. You do it over and over and over, and you'll find yourself slowly over time, you'll be less distracted. You'll notice when the thoughts arise. You'll notice in your body, like, for example, it's been almost 17 months since my brother died. And when he died, I was on overwhelm for all 17 of those months. So I would try to sit down and meditate. Emotions would just take me out. I couldn't sit and meditate. I would get, I have a 10-year track record of meditating every single day. I would get 2 days in a row, and I couldn't do it. I'd get another day, and I couldn't do it. So I kept going. But what I discovered was, if I really went deep into my body and noticed in my body where I was sensing stuff going on, I noticed that when I thought of my brother, I'm sitting in my meditation position, right? I'm sitting in half lotus, staring at a wall. When I notice the thought of my brother start to come up, my stomach gets really, really, really tight. My hands start gripping. My body starts getting warm. I start sweating. It's interesting to note that I can see those things come up before I notice the thought about my brother. So if I see those things come up in my meditation, I know, okay, relax the stomach, relax the arms, relax the hands, just take a deep breath, cool it off, and I can do an end run around it. So last week I was on this retreat. There's the first time I had that tool, and it was a teacher gave me that tool. So you can do it yourself, 10 minutes a day. And then if you really want to get good at it, you have to have somebody comment on how your meditation is going. Someone you can ask questions of, hey, this happened in my meditation. What should I do about it? And that's where teachers come in. And there's There's lots of Buddhist meditation teachers. You can use Insight Timer, it gives you all kinds of information, lots of different teachers. There's also just secular meditation teachers that are out there, and anybody can teach you how to do, 10 minutes a day.
Yeah, they have wonderful apps now, but so a lot of very successful people I've noticed, Ray Dalio, Jerry Seinfeld, Howard Stern, the list goes on and on, are all big into meditation and transcendental meditation, the Beatles, so on and so forth, where they have a mantra, and that could be something that they make up or something that they're given. And it's a real simple thing. It has no word. Can you speak a little about the mantra and meditation, if you're familiar with that, and then
Sure.
how you overcome when the awareness goes away, how you bring it back into focus, please?
So the mantra is just a focus point. Like it's an audio focal point, right? And there's a Tibetan letter. Back in the day when I was studying Buddhism, I was learning to translate Tibetan Buddhist texts into English. So there's the Tibetan letter ah is something that I use to, if I'm losing focus, I go ah really deep, and that sort of brings everything together for me, right? So it sort of brings it together. That's kind of a mantra practice, but some of these mantras are they're repetitive. They just put your mind in a sync. It's just like your breath meditation. It's a focal point. It's an audio focal point. That's really the only difference.
Understood. And then I've noticed sometimes too that there's different variations in length and also in duration, how many times you do it. So is it 10 minutes a day? Is it, some people do 20 minutes and then 20 minutes an hour. I know people that do 2 hours of meditation. Have you experimented with longer meditation? Have you seen an effect, better or worse? Or like, how do you judge how long, or determine, not judge, how do you determine how long and how often your meditation should be?
So I think there's two answers to the question. The first answer, if you're just beginning, 10 minutes is going to be impossible. Like you're going to sit down for 30 seconds the first time, right? And that's fine. Just sit for 30 seconds, right? And then build to 10 minutes. The 10-minute number is really, they did an academic study on the benefits of meditation. They've done multiple, and 10 minutes seems to be like the core number that people come to as sort of a minimum, long-term, stick with 10 minutes. I do know that people that do it 4 hours a day are way more adept at managing their mental noise than people that do it 10 minutes a day. Does anyone that you know of in America, the way we do things, have 4 hours a day to meditate? No, not many people do. If you have a couple, if you're part of a couple, or if you have kids, no, it's not possible. You're never going to do it. I do know people that do it. I know people that do 2 hours a day. What I do is I do retreats every 6 or 8 months, and I get really, really, deep. And we did 13 hours a day for 7 days. So that's very serious. It's very difficult. It's a slog. They warned me it was going to be a slog. It was a slog, as I was warned. But then if I do that retreat and then I schedule another one at 6 months out, then if you just think about how some of the brain psychology that you've written about works, the 3 months after the retreat, you're still living off of that energy from the retreat. And then the 3 months before the next retreat, you're looking forward and you're anticipating the slog, the difficulty of the next retreat. So you're gonna maintain your practice because you have these bookended retreats.
Understand.
Structure. I try to do 30 minutes a day with retreats every 6 to 8 months.
I love it. Yeah, that gives yourself structure and it gives you something to look forward to. So your future casting. I love that. Okay, I guess, Jonathan, last question for you is, what's the best piece of advice you'd like to share with the audience or your 30-year-old self, or something along those lines?
I think that the battle that we face in financial services, and this is both for advisors and for clients, the battle that we face is we are surrounded, absolutely submersed in people that believe that prediction is possible. And I think that ends up being, every time a client wants to make a change to the portfolio because of something that they've read or heard, that's because they've fallen into prediction. Every single time, and it happens daily. I get a call daily. Hey, there's this, I hear the U.S. dollar is going to go down in value, and therefore we should probably get out of U.S. markets. Or, hey, there's this thing between China and Taiwan, and we should probably get out of markets. Or, hey, this pandemic just happened, we should probably get out of markets. And every single time it happens, you're like, no, the plan says commit to equities, do this. So the number one thing I think that we should all do, after we're saving enough and investing in equities, is stop predicting. Stop predicting. You can't predict. If there's no facts about the future, you can't predict. Stop trying, stop trying, stop trying, stop trying. So stop predicting, but then what are you going to do instead? Well, you're going to plan, stop predicting, start planning, and then always, always, always stay mindful.
I love it. I love it. I love it. I'm in the same boat. I don't even know what I'm eating for dinner tonight, let alone where the market's going to be in a year. So I love it. Jonathan, thank you so much for coming on the show. This has been an absolute pleasure. People can get the book. It's called Mindful Money, Simple Practices for Reaching Financial Goals and Increasing Your Happiness Dividend. And I'm looking forward to your next book that's coming out. Do you have a title yet, or is that still up in the air?
Mindful Investing. I'm taking the 2 chapters that we talk about investing. I'm expanding it.
Love it. Love it. Love it. Well, hopefully we'll have you back on when the book's out.
Sounds good. Thanks, Adam.
Thank you very much, John.